Professor Rosa Giovanna Barresi is an adjunct professor at the University of Florence and a key researcher in the BABEL group. Her research focuses on digital assets, financial market infrastructure, international financial regulation, and cross-border banking supervision. She co-edited Digital Assets and the Law, Fiat Money in the Era of Digital Currency for Routledge Giapichelli Studies in Law series. Scientia Professor Ross Buckley is an ARC Laureate Fellow at UNSW Sydney. He serves on the Payment System Board of the Reserve Bank of Australia and as the chair of the Digital Finance Advisory Panel of Australia's Financial Market Conduct Regulator. His research focuses on central bank digital currencies and the regulation of digital finance more generally. Professor Teresa Rodríguez de las Heras Ballell specializes in commercial law, law and technology, and international transactions at Universidad Carlos III of Madrid. Her research focuses on the digital transformation of markets and platforms, emphasizing digital currencies' legal implications for international commerce. Professor Shuji Kobayakawa is a monetary economics and financial systems expert at Meiji University. Previously working at the Bank of Japan, he brings extensive experience in international financial cooperation and the Japanese perspective on digital currencies. Professor Poonam Puri is an internationally recognized expert in corporate governance, corporate law, and securities regulation at York University. Her work examines regulatory frameworks for financial innovation and the governance implications of digital currencies. Professor Deepankar Roy is an authority on fintech, digital payment systems, and blockchain technology at the National Institute of Bank Management. NIBM is an institute established by the Reserve Bank of India, India's central bank. His research focuses on the potential of central bank digital currencies to promote financial inclusion in emerging economies and look at operational risks associated with crypto assets. Dr. Jürgen Schaaf is an advisor at the European Central Bank, focusing on digital currencies, payment innovations, and their implications for monetary policy and financial stability. His work provides insights into the ECB's approach to regulating digital currencies.
Good afternoon. It's my deepest gratitude to all those who made this event possible, to each of you present here today, and of course to the distinguished speakers. This panel offers a unique platform for a multidimensional exploration of the evolving landscape of the digital currency regulation, through a rich diversity of geographical and institutional perspective, from Australia to Japan, Canada to Spain, India to the EU. I want to throw my thoughts before giving the floor to the distinguished speaker. And it's something that I also heard from the previous panels. So our economy relies on three major enterprise models based on three different financial structures: post-World War II conglomerates, service-based enterprise, and the rather new personal conglomerates. So this new form of conglomerates groups several diversified activities under the personal control of a single individual. Its activities are focused on the supply chain in order to gain exclusive access to critical resources, negating them to the competitors. As the economy evolved, regulation efforts have needed to widen their scope. The first ones were about the consumer investor protection, latter regulators has to widen their scope to service provisioning. Now, personal conglomerates are conveniently rely on private debt, whose risk is covered by third party. Even when provided by a bank, private debt lies outside the regulatory perimeter. Its impact on the economy is probably underestimated, as it happened with the derivatives and the collateralized debt application. So the combination of stable coins and private debts offer even more opportunities in developing new financial architecture. Until now, stable coins were used as a store of value or a means of payment. Now, using them in private debt at corporate level looks a quite different use case and will also create a new problem for regulators. So this leads to the following question. How are regulators, supervisors, reaching to this trend? Are national regulators or supervisors doomed to disappear as happened with the national airlines? What should be a sensible strategy for regulation? That was my thoughts. And now I'm very happy to give the floor to the first speaker, Professor Buckley from Australia.
Thank you very much. Is this working?
Not
yes,
working?
It's working. This one.
It's working, it's fine.
It's working? Okay, very good. Thank you. Thank you for the invitation, Filippo and Rosa. It's been great to be here. So I'll start by taking a step back and think about how do central banks regulate, how might they better regulate digital currencies, and then how might they coordinate those strategies. And I think the first problem central banks have with regulating digital currencies is they're filled with boring people, right, by their nature. Okay, right, it's got to be right in my mouth. Okay. Okay. Mervyn King, when he was Deputy Governor of the Bank of England in 2000, said, "Our ambition at the Bank of England is to be boring." You know, I recommended a book to a department in my central bank at home, and I said, this has got a really useful stuff in it, but it has a paragraph which says central bankers are uninteresting, uncontroversial and boring individuals. And the young people in the room punched to the air and said, great, yes, that's what we want to be, right? The problem is the level of innovation coming down the road in digital currencies is very high. So how do these group of deeply conservative, boring people deal with this level of innovation? And what I suggest is that they do what commercial banks do. If you've noticed, most of the fintech incubators around the world, the startup co-working spaces, are funded typically by the big banks, quietly, but the rent is usually subsidised by the big commercial banks. And this is to the commercial bank's advantage, right? They get all the startups in the one place, they can watch them. The ones that really do well and get established, they then buy. Because they know they can't do that innovation inside the commercial bank. So they do the innovation in the startup incubator, and then they can lay down a few $100 million to grab the ones that work and incorporate that innovation in themselves. And I suggest central banks do the same thing. Certainly that's what mine is doing in Australia. It doesn't use a startup incubator. When I say mine, by the way, I serve on the Payment Systems Board of the Reserve Bank of Australia, but today I'm speaking purely as an individual, not on behalf of the bank. And the stuff I'm talking about is all in public documents. So what my central bank uses is something called the Digital Finance Cooperative Research Centre, which is an amalgamation of 6 universities and a whole lot of government funding researching digital finance in Sydney in Australia. And so what it's done 2 projects with them, and both projects have been run by the Cooperative Research Centre, but they've heavily involved the bank. And I think that's a lot better for the bank than the bank running it itself. Works much better. The first one, they did something really interesting. They said, let's not worry about how we build a CBDC or etc. Let's worry why we would need one. So they invited industry to make bids for use cases, for projects, and they were blown away by the response. They got 110 organisations wanting to build and use a CBDC in some commercial application. And they chose 16 of them, they issued CBDC, they to these organisations, and these organisations, the whole goal was they didn't want a paper, that they wanted to show it working. Then they had a day at the end where all 16 organisations showed the CBDC being used, and then they hoovered it all up, vacuumed it up and took it away. And there were a lot of lessons and shut it down. And there were a lot of lessons from that. And one of the lessons was that the central bank and the market conduct regulator, ASIC, needed to learn to work together a lot better, because using these use cases typically required financial services licenses or some sort of licensing arrangement. That the market conduct regulator wasn't keen to come to the party and give in a prompt manner, which was sort of silly because this was only, in a sense, a sandboxed thing. There was a fence around this. There wasn't any risk really to consumers. So when we're doing the second pilot now, the market conduct regulator is on board much more. So we are learning from it. But that was absolutely fascinating, how many use cases there were for CBDCs in Australia. For instance, I had no clue. There's $3 billion worth of cattle sold in Australia every year. And it would work a whole lot better using a CBDC to make payment than it would using bank payment rails. The more recent one is something called Project Acacia, and this is only part way through. This one explores how digital money could support the development of tokenised real-world asset markets in Australia. So making digital tokens that represent title to real-world assets, those assets are being traded, and the preliminary feedback from the 15 or 16 industry participants in that is what they really want, is they want a CBDC so it can run on the same blockchain as the asset, the digital asset token. So then they get atomic settlement when the title doesn't move except in response to payment. If one side of the transaction doesn't happen, the other side doesn't happen. And that's been really interesting, that every industry participant, that's what they want out of this. They want CBDC that'll run on the same blockchain so that the software works much, much better. So these are really useful sorts of learnings, I think. And the central bank gets them by partnering with industry, using a research centre or using somebody else like that. So that's the first thing I'd like to sort of highlight, that I think central banks need to reach out and be much more proactive working with industry, setting up these pilots in this sort of what Dirk and I call sandbox thinking, some of our papers. The second thing is, having done that, how would we regulate more, the formal topic today? How do we coordinate the regulation internationally? And the first thing I'd say is that the first project that the Reserve Bank of Australia did was a wonderful example of this, because I've spoken to so many people overseas who thought it was a failure, including some very influential Americans who thought, oh, you did that over there, that didn't work, did it? So we thought it was a wonderful success because we learned so much out of it. But what overseas often heard was, well, it didn't, one of them said, well, you don't have CBDC now, so it was a failure. So it's sort of, which was never intended to be it was intended to be a pilot. What we learned from it, never intended to be a complete restructure of the whole Australian financial system. So what it highlights for me is how difficult it is internationally to communicate, well, what is being done and to share those learnings. Even in this trip in Europe, I was in Zurich before here, and that was put to me again in Zurich. Oh, you did that use case project, but it was a failure. It didn't work. So obviously the communication is a really big challenge. Other things I think that are needed is you need to identify the areas that require regulatory harmonisation to minimise legal risk. We've heard a bit in this good event already a number of times. It's never the technology that is difficult, in my experience. When I started researching this, I thought the problem would be building CBDCs. This is probably deeply related to the fact that I have a lot of trouble even making my iPhone work. So I'm really not a technologist, right? But the technologists who I deal with say, no, that stuff's easy. The hard stuff is the governance. The difficult stuff is the governance and the law around this. So the first thing, I think, if we want international regulatory coordination, we have to identify the areas where countries' laws will need to be harmonised. And Project MBridge was a really successful ongoing project. which therefore America has pulled out of, as you'd expect it to. And they've identified, that project, the IMF identified legal characterisation of a CBDC, what is it legally, settlement finality, data privacy, AML, CTF sanction regimes. They were just 4 areas in the IMF report that they said if you're going to have regulatory coordination, you need some harmonisation on those areas of law. The second thing I'd say is you've got to think about legal and governance at the same time as you're thinking about technology. It seems to be a sort of a human thing that we think, we'll build it and then we'll think about how we govern it. And that really doesn't work. And at home, ASIC recently did a study on AI adoption. AI adoption's been very slow in Australian companies. But they did a study on it and they found about 17 companies that were using it quite a lot. And the big thing they identified was what they called a governance gap. In other words, the companies had started using a lot of AI before even thinking about how they were going to govern the use of the AI. For some reason, human beings think you do it first and you govern it second, but you really need to do it in parallel, not in sequence. The other thing I think for international regulatory coordination, you've got a big question up front, which is are you going to run it legally as a platform or are you going to run it on a transactional basis? And what I mean by that is if you've got a hub that's trading CBDCs, that facilitating the exchange of CBDCs to promote international trade, is every legal system that's interacting with that hub going to have to comply with the rules, or is it only the 2 for the particular transaction that have to be compliant? Because if you take a platform view where everybody has to comply, you're probably going to end up with the country that has the toughest rules governing the whole thing. If you take a transactional view, then it's only you need the harmonisation, the compliance between the 2 countries' CBDCs that are interacting. So that's sort of a threshold issue, and you've got to sort of decide that. Once you've decided that, I'd suggest you need a rule book. Rule books work really, really well in, it's a bit like driving on the side of the road. You people drive on the wrong side over here, but it doesn't really matter. I manage to cope when I come over, right? We drive on the other side. It doesn't matter which side you drive on. You just better have a rule on which side you better drive on. And it's the same, with this stuff. You just need a whole lot of rules to make this thing work. You need a governance approach that actively manages legal and regulatory risk. I can't sort of emphasise this too highly. Because of the sexiness of the technology, the attractiveness of the technology, people tend to focus a lot on that, but that's not what's going to make the thing succeed or fail. Pretty much these days we can be guaranteed the technologies are going to work. The other thing I'd say is at I'll sum up actually. So to sum up, I'd say 5 things. Think about technology and legal and governance in parallel, not one after the other. Identify areas that require regulatory harmonisation to minimise legal risk right from the beginning between 2 countries' legal regimes. Decide if your governance is going to be based on a platform-wide view or simply on a transactional basis. I'm not saying you should do one or the other, but you've got to make the decision. Having made the decision, develop a rule book, and finally, develop a governance approach that actively manages legal and regulatory risks and provides a way to resolve disputes between countries. In all of this, what I'm really speaking to, I think, is, to my mind, the great opportunity for CBDC in our world is in international payments. Our current international payments regime is nothing less than a scandal, right? It's so slow and it costs so much to pay. In any developed country now, I can pay any Australian in 30 seconds, any amount of money. But the minute it becomes across a border, it costs 1 or 2 percentage points, costs 3 or 4 days. This is ridiculous, guys. This is from the 1960s. CBDCs will fix this really well, but to fix it, we need to address the legal and governance stuff at the same time as we're developing the actual CBDCs. That's enough from me.
Many thanks, Professor Buckley, and I give the floor to Professor Kobayakawa with the Japan perspective. Thank you.
Well, thank you very much for your kind introduction. I'm grateful to be here, and my thanks go to Rosa, Filippo, and other organizers of this conference. Let me first touch on a couple of issues from our earlier discussions. And there was a discussion in this morning that unconventional monetary policy tool, the CBDC, can be. I've discussed this issue, when I was at the Bank of Japan for a number of times. In fact, I was one of the authors of the first BIS CBDC report, which talked about in money flowers, and I apologize if there was any confusion in academic circles. But in any case, that we weren't persuaded by the fact that conventional monetary policy tools, if there's anything that conventional monetary policy tools cannot do, which can be replaced by unconventional monetary policy, like CBDC. So, the current policy tool still works in order to achieve the price stability at the end of the day. And in fact, Japan has finally reached our inflation is more than 3.5% in terms of CPI, and we were the highest CPI country among the G7 member countries. So the problem is that what are the things that the CBDC can do while other conventional monetary policies like monetary operations cannot do? That's something that, we won't be persuaded yet. And also that I will point out that once you do the quantitative, qualitative monetary easing, all sorts of things, it's difficult to reverse your course. As you know, when you look at the balance sheet of the Bank of Japan, it holds 500 trillion yen worth of government bonds, which is almost equivalent to the Japanese GDP, annual GDP. So you think that balance sheet is enormous. And also the Bank of Japan buys corporate equities using the equity trust funds. And name some big Japanese companies like Uniqlo. You know who the largest shareholder of Uniqlo is? It is Bank of Japan. And other blue chip companies that most of the other blue chip companies, the Bank of Japan is the largest shareholder, and that creates a lot of distortions from the perspective of corporate governance. So it's very difficult to reverse this course because once, if there's any kind of speculation in the stock market, the Bank of Japan is starting to sell its equities, it creates huge gyrations in the market, particularly in this time of the year when blessing is coming from the United States. I think there's still lots of things that we need to think about before resorting to such unconventional policies. And second thing that I will point out about the Asian development as far as the CBDC is concerned is a lot of people are interested in China. So there was some discussion about, the People's Bank of China issuing a digital renminbi directly to the end users. Maybe in exceptional circumstances, that may be so. But the PBOC does not intend to provide digital renminbi directly to the people, but they take advantage of a tiered structure. Under which that there is a thing called authorized operators, which consist of 5 national banks, including Bank of China, which is the largest financial conglomerate in the world, and 2 commercial banks. One is owned by Ant Financial Group, and the other owned by Tencent. These authorized operators issued digital renminbi from the PBOC, and those banks are responsible to distribute digital renminbi to the end users. So this tier structure is firmly embedded in the current framework. But having said that, PBOC faces a number of challenges to find the use cases of digital renminbi, and they come up with all sorts of ideas, most prominent of which is that G2G transactions. I'm sure many of you are aware that banning bribery in China is a big thing, that we come, every now and then some senior military officials suddenly disappear from the public domain, only to find later that he's being imprisoned and things like that. So bribery, how to avoid bribery is a very big issue under the current premiership. And what they came up with is that when the federal government provides subsidy to the provincial governments, they put programmable money using the digital renminbi, so that local provincial governments can only use digital renminbi for the purpose of paying, like, hospitals or medical expenses, but not being able to give money under somebody's shoulders or something. So this is one of the use cases that came up. Another one was that the G2C transactions, that government employees being paid by digital renminbi, but only to find that those people who receive their salaries will transfer digital renminbi to their bank deposits. Why they have to look at these G-related transactions is, again, as you know, the Chinese people lives are very much oriented by extensively using Alipay and WeChat Pay, super apps, and which basically takes care of everything that the Chinese people do. Not only buying, things, or even if you want to find future spouses, wives and husbands, that they resort to those apps to find the people with a excellent credit scores. These examples tell you, how much that the Chinese community, this super application is penetrated in their daily lives, and it's very difficult to find the room for digital renminbi to replace such applications. So that's part of the reason why they started looking at cross-border issues. Yesterday, that people talked at One Belt, One Road initiatives. Of course, yes, digital renminbi being used in Middle East, Africa, and things like this. And another example is that when you look at areas like Greater Bay Area, which spans Hong Kong, Macau, and Canton. They look at this region as a way to make supply chains more efficient. So these are some of the developments in mainland China. But again, it's very difficult to find a persuasive use case for the digital renminbi. Now, looking at ASEAN countries, again, the people have already talked about, but most of the ASEAN countries has posed their retail CBDC initiatives. For example, Bank of Thailand has been running the pilot with the extensive participation of merchants and end users, but they stopped after having published a very nice research paper on that. And even countries like in Indonesia, they have a project called Project Garuda, but which starts from wholesale CBDCs rather than retail CBDCs. So more and more countries are putting more, central banks are putting more resources on wholesale CBDCs, and also that somebody earlier touched on Project Nexus. Again, this is a very important initiative that core ASEAN countries have been involved, along with India, UPI, and ECB participating as a special observer. But this initiative does not necessarily make use of CBDCs at the moment. They take the phased approach, in the sense that the current framework use the FMIs, like deferred net settlements of respective countries, but maybe in the future that those settlement mechanisms could be replaced by stable coins or CBDCs. And wholesale CBDC of respective countries will play in as the framework develops. So just a few footnotes, comments to earlier discussions. And coming back to the main discussion, I will say three things that I think, as far as the global regulatory coordination is concerned, we need to have we need to avoid any confusion regarding what we mean by stable coins and what are the deposit tokens and things like. So some people would say that well, stable coins include those issued by commercial banks, while others will not say that. But from our point of view, that the mechanism to stabilize the value of deposit tokens does not necessarily rely on the collateral or the safe assets, but rather the soundness of the bank's balance sheets as a whole is the underpinning of the safety or the stability of deposit tokens, which have, one way or another, has to be differentiated from the way that stable coins maintain its stability. Now, second point is, which is related to what I said earlier, is that I think this is an issue which hasn't been touched in this conference yet, but the scope and the way in which stablecoin reserves or the safe assets must be treated are treated in different economies require further scrutiny. So, for example, the current Payment Services Act in Japan, which is the Japanese version of MiCA, if you like, in this part of the world, say that Japanese entities can issue USD dollar-denominated stable coins, but Japanese government only allows the underlying safe assets either time deposits or U.S. treasuries with the maturity of less than 6 months. Whereas when you look at other at the stable coins issued in the United States, they can even accept a much wider range of assets, including MMFs. So it is not clear to me yet that whether those stable coins with the same denomination, the USD, but issued in different jurisdictions, Japan and the United States, can preserve the singleness of money without the backing of the central banks. And I think it is in that context that respective roles of the public money and private money should be reviewed once again. And lastly, that I think the efficiency gains stemming from the stable coins can be created in cross-border, that can be created in cross-border transactions should be pursued somewhat in the long-run perspectives, while policymakers need to be aware that there are alternative solutions to realize such gains. I touched on the Project Nexus, which at the moment doesn't necessarily rely on the CBDCs, but they take full advantage of the network effects that are already achieved by current market infrastructures. At the same time that it gives latitude to replace the settlement mechanism possible by stable coins or wholesale CBDCs, as I said, in the future. So to sum up, I think technology is advancing at an ever-increasing speed, and global regulation cannot escape from follow the market principle. Under such situations, it should be flexible enough to accommodate future needs without stifling innovation, but also requires further coordination to pave the gap market participants are likely to identify on a global scale. So thank you very much.
Hello? Okay. Many thanks, Professor Kobayakawa. And it's my pleasure to give the floor to Professor Poonam Puri from Canada. Thank you.
Thank you, and delighted to be here. Thank you to Professor Barresi for chairing the panel, and to the organizers, Professor Zati and others, for the invitation. Today, I thought I would focus on the Canadian experience and approach to regulating crypto assets and trading platforms, and how that approach compares with developments in other jurisdictions. Our kind of central bank has put on pause the issue of kind of moving forward with central bank digital currencies for the moment. So thought I would share kind of another perspective on what we're doing in terms of crypto assets. Obviously, in terms of other panels today and yesterday, lots that is a work in progress in Canada and elsewhere in terms of some of the themes that we are discussing on this panel and prior panels earlier today and yesterday in terms of the evolution of the market that is faster than what most legal frameworks can keep up with, and also the use of legal frameworks that are kind of, mission fit for the past, but not necessarily mission fit for what we're dealing with currently or the future. And clearly another theme of the other panels and ours is, that coordination across jurisdictions, of course, is complicated, particularly complicated when it comes to digital assets, and obviously consequential in terms of these assets being highly portable, issued outside of the reach of actors that are, when we're talking about private digital currencies, beyond the reach of any single sovereign. And again, this kind of capability of rapid innovation that can really outstrip traditional regulatory responses. And so obviously that creates the issue of regulatory gaps, and it creates the issue of inconsistencies within jurisdictions, but also amongst jurisdictions that can be exploited. And of course, as everyone here knows, given the expertise, these gaps can undermine financial stability on a cross-border scale. And so, coordination, of course, from my perspective, and clearly what I'm hearing from others, is desirable, and perhaps even more than desirable is necessary. And so the tools that we use, the legal traditions that we draw upon, and how I think, importantly, regulators and others kind of balance the innovation that we're seeing with the risk and risk mitigation strategies is important to kind of put directly on the table, and it varies across jurisdictions. And I think this variation of kind of how do you balance innovation and risk is what makes discussing the Canadian experience so interesting. I think Canada was an early mover in regulating crypto assets, in particular private crypto assets. It is often held up as an example of early regulatory leadership in the crypto space. And I think it genuinely was a first mover. In 2014, so over 10 years ago, Canada became the first country to pass comprehensive legislation comprehensively regulating Bitcoin and other digital currencies. It was called Bill C-31, and tabled with other budget initiatives. It brought virtual currency dealers under essentially the same kind of reporting and regulatory standards that are applied to traditional financial institutions. Now, obviously, that we'll talk about why that could be a problem, but it did its part in terms of we're going to take our existing framework and say these new kind of dealers, these new entities are going to be subject to this kind of old legislation. The bill also amended our Proceeds of Crime, Money Laundering, and Terrorist Financing Act to treat virtual currency dealers as money service businesses, subjecting them to the same rules that others in the marketplace were subject to, and also requiring them to register with FinTrack, which is Canada's financial intelligence unit. And I think this was a significant proactive step, especially at a time when in 2014, and I welcome being corrected, I think many jurisdictions were still taking a wait and see approach to digital assets. And I think many, thought that perhaps crypto assets wouldn't be around today in the way that they are. But Canadian regulators were trying to figure out how to deal with the growing number of crypto exchanges that we were seeing in Canada, or as we call them, crypto asset trading platforms, setting up shop. And at that time, something called Quadriga CX happened. And it was Canada's largest crypto asset trading platform. It collapsed dramatically in 2019, as some of you will remember, after the sudden death of its CEO, Gerald Cotton. And the shocking revelations that followed were shocking. Cotton was reportedly the only person with access to the exchange's cold wallets, which supposedly held most of the customer assets. After his death, Quadriga announced that it could no longer access over $250 million in crypto assets and fiat owned by more than 115,000 users. The Ontario Securities Commission investigated, and it revealed that the real story was far worse. The Ontario Securities Commission discovered that Cotton had been conducting or committing extensive fraud, creating fake accounts, crediting himself with fictitious balances, and trading against real users. He misappropriated millions of client dollars or client assets to fund his personal lifestyle and speculative trades on other exchanges. And I know it sounds like other fraud since then, but this was, one of the large first ones. And it turns out that Quadriga CX had been operating like a Ponzi scheme, and the results weren't just the losses of inaccessible wallets, but also systemic misconduct. And so when the dust had settled, it was well over the initial amounts of client assets that had vanished. And I think the crisis that happened with Quadriga in 2019, as much as we, were one of the first movers in 2014, exposed serious gaps in Canada's regulatory framework at the time, but it also galvanized Canadian securities regulators towards action. Now, in Canada, we have a federated structure where securities regulation is handled by 13 provincial and territorial securities regulators. Despite that, there was still swift and coordinated response. Usually, our policy changes and rules take years and years and years for various reasons, but including our federated structure. In this case, the federated structure was not an impediment. Through the Canadian Securities Administrators, the umbrella organization of all the regulators, they put together a comprehensive regulatory framework for regulating crypto assets to make sure something like Quadriga CX couldn't happen. And it started with a consultation paper seeking public comment, as often is the case, of course, and to try to address some of the novel features and some of the risks associated with CPTs, including a potential lack of investor safeguards, including conflicts of interest, including kind of price transparency, and including the issue of security controls, which obviously all points that we've been talking about in different ways at the conference. And so the CSA, the Canadian Securities Administrators, also sought input on any global approaches that Canada should consider. And so where did we end up? So we, rather than developing bespoke legislation, mission fit for kind of the new market, Canada ultimately chose to regulate crypto assets primarily through its existing securities and derivatives laws. And these laws are enforced at the provincial and territorial level, and there's some coordination through the national umbrella body that I just spoke about. And it's very much a principles-based test drawn from Canadian case law, often referred to as we know, the Pacific Coast Coin Test. Lots of standards in terms of, which I'm not going to go through in terms of, what's an investment contract or not. But if the crypto token, crypto asset meets all four criteria, it's considered an investment contract and therefore a security under Canadian law. And lots of criticism about this as being overly broad and too inclusive and kind of, not allowing innovation to happen. But we can speak certainly more about that. Crypto regulators also extended this logic to the trading platforms by not just focusing on the assets, but also on the platforms that were being used to do the trading by users, even though the many platforms don't actually, and I think the issue is that many platforms don't immediately deliver the crypto itself. And so, as has been talked about, of course, is the custody piece, and that's why the Canadian securities regulators decided to focus on the crypto platforms as an entity that they could regulate perhaps better than the crypto kind of creators. And so, Canadian regulators were able to require that the trading platforms enter into crypto contracts with clients and that they register as dealers, kind of what our traditional dealers are in the capital markets and or our kind of traditional marketplaces like stock exchanges. And then on those trading platforms impose kind of the full suite of conduct regulation, custody regulation, disclosure requirements with some kind of exemptions from that relief as needed. And so Canada used kind of an existing platform to deal with a new situation. And so what I'd like to briefly mention before my time is up, no doubt, is kind of the issue of enforcement capacity. Because we don't have a centralized national regulator, we don't have the same scale of enforcement resources, some would say. There are lots of unregistered crypto trading platforms already operating in the Canadian marketplace. Shutting them down by the regulators, they thought was not feasible because it could have caused real disruption for Canadian investors who were already, or Canadians who were already using these platforms. And it would go against the regulatory objective of trying to promote some level of innovation and foster competition. So the regulators took a different approach. They kind of took the approach of pre-registration undertakings, or PRUs, to try to kind of get to enforcement with what they saw as the new regime that should happen. And so a pre-registration undertaking is a formal binding commitment that the unregistered crypto trading platforms out there filed with the Canadian securities regulator to say, look, we're going to try and meet all of the investor protection measures and regulatory standards that you expect of registered platforms, even before we register, while we're trying to register, so that we're not offside. And so now the self-regulatory body for traditional investment dealers is taking over that framework. One could question whether it is the right kind of entity to be doing that, or whether a new entity should be created, but that's what's happening here. And this strategy and this framework is now being extended to stable coins, or as we refer to them kind of in the Canadian, regulatory environment, value reference crypto assets. So unlike some jurisdictions which regulate stable coins under prudential frameworks, Canadian regulators generally treat fiat-backed stable coins as securities or derivatives, and that means they've got to comply with prospectus requirements and or other issuer requirements. And again, that can create a different type of burden, which we're happy to talk about. Lots in the works in terms of potential regulatory approval. Let me just skip over a couple of things and kind of my final remarks before I pass it back to Professor Barresi. I think the regulatory framework that we have for crypto assets, I think was recognized for early leadership, and to some extent, there was a good pragmatic use of existing assets, but I think the question we're facing now in Canada, whether this model is still fit for purpose, both domestically and globally. And one of the clearest signs of friction lies in the slow transition of crypto trading platforms towards full registration. Why are they not registering in the new framework? Why are they going to other jurisdictions instead? Why and what is holding them back, I think, is a relevant issue. Is it that the compliance expectations are too high, especially for capital, the capital expectations, the custody expectations, the insurance, the operational controls? Is the process of registration itself too resource intensive, particularly for smaller ones or international ones? And then what are other jurisdictions doing that is perhaps easier or different than what we're doing in the Canadian context? So kind of working through that bottleneck now. With that, let me pass it back to Professor Barresi, because I know I have gone well over time. Thank you.
Thank you very much, Chair. Thank you very much for having me today. I would like to thank first Professor Zatti and Professor Barresi for inviting me. I feel very, very pleased and privileged to be part of this conference and be part in particular of this panel. I'm not going to take a Spanish perspective on what we are having or how we are contributing to the global coordination of regulation of cryptocurrencies. I would like to share, however, my experience from the international harmonization project that are not dealing with cryptocurrencies in particular, but with digital asset in general. And they are not talking about regulation, they are talking about private law in general. And why is that? Because I would like to share with you my thesis, the main thesis that I have used in order to prepare this intervention, that is essentially that cryptocurrencies emerge from the intersection of technology, regulation, and private law. And we cannot detach any of this layer. So we cannot design a global coordination strategy if we only focus on financial regulation, or if we only focus on cryptocurrencies. And that is because cryptocurrencies, from a technological and private law point of view, they are part of a broader category, that they are raising a number of concerns, a number of challenges. That is the category of digital asset, first. Second, because any decision that we adopt at a regulatory level has to be properly coordinated with and has to be properly based on a prior private law policy decision. I'm going to explain the 3 layers in my conviction that we cannot focus exclusively this global coordination strategy on the regulation of cryptocurrencies. On the contrary, has to be a 3-layer approach and has to be broader in terms of the material scope. Let me first start with the idea of why digital assets are a technological phenomenon. It's very obvious, but from a legal point of view, has a very clear connotation that I would like to raise. Digital asset, and therefore cryptocurrencies, and therefore crypto asset of all kinds of subclasses, they have been embedded into the legal world with a very, very particular, original, and promising notion. The notion of controllable electronic record. Electronic record that represent a value and that they are capable of being subject to control. From a legal point of view, this is extraordinary challenge. This is extraordinary that we manage to incorporate in our traditional vision of how value is represented, how value is created, and how value is transferred in the economy. We have decided to accept that we have a new technological way to do it. Because this technological way to do that is so distinctive, because they have new characteristics, new features, not all of them very clearly fit into the existing legal categories. And this is the challenge. This is the challenge. So as you can see, the first decision has been to create this notion of controllable electronic record, based on 3 notions at the same time. Value, we talk about value, and value could be in a non-fungible token, could be in a CBDC, or could be in a cryptocurrency of any kind. Second, we talk about electronic record. Exactly, we're talking about data. We're talking about digital forms. We're talking about an electronic record, very particular. Very particular. This electronic record can be subject to possession, in particular using a specific control method. Very much accommodated or adapted to the technological particularities of this kind of digital asset. In most of the cases, DLT-based, even not necessarily. So when we talk about the private key, the wallet, the digital distributed layer technology infrastructure, we are talking about accepting from a legal perspective that this kind of technology are providing us with mechanism to control value. And because of that, we have found an equivalent to possession, an equivalent maybe to ownership. And that is for me absolutely crucial. The second level, and as you can see, sorry, I'm using the wrong direction. At the same time, as you can see, once we have this notion and we try to compare this broader notion of controllable electronic record with existing legal categories, securities, we talk about bonds, we talk about financial instrument, we talk about money, and we talk other kind of asset, we realize that there is an area where we cannot find an equivalent in the existing law. And this is the challenge of to which extent we need specific rules for this emerging category of asset that we call digital asset that are not in particular fitting into the existing models, either financial instrument, either general asset, either money in particular. The second level is, once we define this technological phenomenon, electronic record that represent value and can be controlled. Now the second level is how we apply the fundamental basics of private law to this new asset. Because they do have characteristics that they are not the same that we use when we apply possession, when we apply ownership, when we apply transfer, when we apply many notions that we need for the purpose of deciding, for instance, to which extent we can sell digital asset, we can pledge digital asset, we can enforce against digital asset. All these questions cannot be solved, cannot be replied, unless we solved the challenges at the private law level. And I will come back to that in a minute. So at the private law level, we have formulated the following statement that is a harmonized statement at the international level. A digital asset can be the subject of proprietary rights. It's something similar to say in common law, digital asset is property. But as you will see, it's not exactly the same, and it's not to be undisputed or uncontroversial at all. At the same time, we are making the distinction between digital asset, that could be, for instance, Bitcoin at the very end of this spectrum, but at the same time, linked asset. That could be what we call in the financial environment, referenced asset, for instance. And this is very useful because it's the way that we have to connect stable coins, to connect non-fungible tokens and many other tokenized property, immovable property, to connect that with existing legal institution that we have in private law. Securities, financial instrument, title of credit, and many others. So as you can see, we have decided how to cover this broad category with two different approaches, either linked asset or digital asset in particular. And the last one that is absolutely crucial, and we cannot ignore that is a fundamental step forward, is that we have decided that using this particular technology, wallet, private key, DLT, the thing that we do, control, the thing that we do is equivalent to possession. This is not obvious, it's not per se a natural conclusion, it's because we have decided to accept it. And that means that I could be the owner or I could have possession of a digital asset, and that is the reason why I can deliver, I can pay, I can, of course, I'm just simplifying very much, but it's key to have that, otherwise we cannot go to the next step, because the next step is now what happened at the regulatory level. Regulation is not going to cover all the different aspects related to digital asset, but it's going to focus exactly on the area that we have been discussing the previous day in this conference, the area that is related to certain activities, that is related to certain intermediaries, and is related to certain digital asset. Not all of them. Is covering certain digital asset because they are means of payment, because of the function, because of the design, because who is the one who is issuing? It's a discussion. Therefore, in my opinion, and this is my starting point and the main idea that I would like to share with you, is that we cannot try to coordinate only at the regulation level, thinking that if we manage to coordinate and harmonize regulation on crypto asset around the world, we are going to solve the problem. Because many of the disparities at the regulation level, they are coming from disparities at the private law level. For example, the different approach to what property is when we talk about digital asset, or the different notion of control, for instance. And that is the reason why we find some divergences at the regulation level. Regulation level cannot play in isolation, in vacuum, is strongly dependent upon this kind of prior private law concept. That is the idea. So the next point, very briefly, is we already have very important international harmonization instrument that, in my opinion, are paving the path to arrive to a global, coordinated, harmonized regulation. Of course, I understand that we're talking about different policy goals. Naturally, there are sovereignty sensitiveness involved. There are naturally different interests. I agree that. So we can accept a level of disparity at the regulatory level for all the reasons. But certainly, if we have a very sound foundation, the regulation is going to work better. So this is exactly what we have at the moment, as you can see. So we have two UNIDROIT instruments talking about digital asset and private law, and enforcement. We have a toolkit by UNSW on insolvency. And then we have the European Law Institute principle and model rules on digital asset as a security, fundamental for financial environment, and enforcement against digital asset. Naturally, the Hague Conference is working on the CBDC as well, and it's very important. But I just would like to conclude in a couple of minutes, if I may, trying to show you why, in my opinion, this idea of compiling the three level is fundamental and is correct. I'm going to show you in the next 3 slides case law that is demonstrating that the court is unable to find a convincing solution precisely because the previous level, it is property, is not property, is controllable, is not controllable, has not been solved properly. That is the reason why we cannot work on regulation unless we work first on the 2 level. If I may have 2 minutes more, I would like to show you this selection of case law. So we cannot talk about money. I'm sorry for just entering into such a complex and slippery area. So we cannot talk about money, banknotes, we cannot talk about means of payment if we haven't first solved the problem of if it's an asset or not, if it's property or is not. Let me give you an example. In this case that you can find One versus Davi, they say cryptocurrencies are property. And that was important for the purpose of this particular action. That was important. First question. Second question. We cannot decide many things related to the regulations, such as what is the applicable regulation, what is the whether they are eligible or not to specific insolvency regimes, whether they have specific obligation or not, whether the compensation schemes are going to be applicable or not. In relation to intermediaries, if we haven't solved first the 2 previous levels. For example, in this case, whether a custodian is a financial intermediary or not was disputed, and therefore we don't know what is the kind of insolvency regime that we are going to apply. Third, and almost I'm concluding, the question of debt, the question of payment, that depends very much on the legal characterization of we do this particular digital asset. Let me give you an example. Can we apply the CISG on sale, international sale, if we pay with digital asset? That depends. Is really a sale with a price, or is a swap? Second, can we really consider there is a money claim? Can we apply specific claims that are only for monetary claims in particular? Can we consider, for instance, that we have insolvency with money debt, or we are talking about tangible asset or intangible asset? And finally, do we need a specific criteria for valuation? If we are talking about money, it's money. Maybe we have to currency exchange rate. But if we are talking about asset, if this digital asset is not currency, we need valuation criteria in particular. So I conclude just by insisting on this idea. Anything that we try to solve at the regulation level cannot be independent, cannot be detached, cannot ignore what has been previously said in private law. And in this new concept of controllable electronic record, that in my opinion is how the law recognizes a new technological phenomenon and provide legal consequences to a specific technological characteristic. Thank you very much.
Thank you very much.
Yeah. First of all, let me thank the organizers for inviting me for the conference. In particular, I'd like to thank Professor Zati and Professor Rosa. I come from India, and I am an associate professor at the National Institute of Bank Management, which is governed by the India's Central Bank, Reserve Bank of India. So I'm going to talk about digital currency regulation and key developments in India's digital rupee, that is CBDC. So I'll initially focus on the cryptocurrency regulation and the status of the same in India. After that, I'll talk about India's CBDC, that is digital rupee, which is already in a pilot program since 2022. So I'll share some of the experiences around CBDC implementation in India and the various use cases and the experiences from an Indian perspective. Well, to begin with, let me talk about the evolution, the regulatory evolution and the legal status around cryptocurrencies from an Indian standpoint. So in 2018, the Reserve Bank of India, India's central bank, it had issued a circular which prevented banks from servicing cryptocurrency exchanges, effectively banning the cryptocurrency transactions through formal banking channels. So there was a huge hue and cry. All the digital asset service provider exchanges, they were not very happy. They all complained before the Supreme Court of India, and finally the ban was lifted by the Supreme Court of India in March 2020, and it restored the legality of cryptocurrency trading, but still there's a ambiguity, regulatory ambiguity. As far as the current legal status goes, cryptocurrencies like Bitcoin and Ethereum are still not recognized as a legal tender in India, and they still operate in a regulatory gray area where the ownership and the trading of the same are permitted, but subject to strict tax and compliance obligations. So in fact, there was a legislation which was brought about in 2021 called as Cryptocurrency and Regulation of Official Digital Currency Bill, but still pending, so it has not yet become an act. There is a lot of discussion that's happening currently. In fact, this bill distinguishes between private digital assets and sovereign digital currency, which is reflecting a cautious stance towards decentralized cryptocurrencies, but at the same time, it supports blockchain technology and its application in other sectors. Going forward, let me talk about the taxation and compliance framework. So as far as the taxation regime goes, India has imposed a flat 30% tax on income from cryptocurrency trading and investment. So whatever profit you make out of selling or buying cryptocurrency assets, you will be levied a 30% income tax. And also for transactions which exceeding 50,000 rupees, there is a 1% tax deducted as source. This is what is the current taxation regime around cryptocurrencies. And as far as AML and KYC regulations are concerned, these cryptocurrency transactions fall under the Prevention of Money Laundering Act 2002, and it must comply with the AML and the KYC norms. In fact, the Ministry of Finance, Government of India, has introduced the travel rule to track cross-border crypto transactions. So if you know about the travel rule, so your KYC also travels with the transaction. That means your address or your identity, both the sender and the receiver, so those have to be actually recorded. And these information also have to be from time to time disclosed before the regulatory authorities. So that is what is the AML and KYC regulations currently. Then, Then it also kind of talks about the virtual digital assets. So this is the term which is being used for all types of crypto assets, including NFTs. And about the licensing regime, India has not yet adopted a registration regime for virtual asset service providers. And the Financial Intelligence Unit of India, it has actually mandated registration of VASPs to comply with the provisions under PMLA. So as far as crypto asset regulation are concerned, crypto assets or VDS, they still remain unregulated in India, and the government of India does not collect data on these assets. And there's a regulation, there's a guideline which has been issued by FIU India that is called AML and Combating the Financing of Terrorism Guidelines. It actually lays out a very clear set of principles for virtual asset service providers. And then as far as monitoring of virtual digital asset transactions goes, so these virtual asset service providers must establish the customer due diligence. So the sender of the crypto payment, his identity has to be recorded, even the receiver, right? And these cryptocurrency exchanges, they have to also from time to time, they have to declare what kind of cybersecurity controls they have implemented, because these exchanges are prone to cyber attacks on a regular basis. So there's an institution under Ministry of Electronics and IT that is called as Indian Computer Emergency Response Team. So this particular organization collects a lot of information about the current cyber security preparedness of all the virtual asset service providers. and also the same have to be reported to the FIU-IND. As far as the banks are concerned, the Reserve Bank of India has actually instructed its regulatory entity, that is bank, to conduct this customer due diligence process. So, I mean, there's no escape. I mean, you have to, your KYC details are mandatory. The moment you open a wallet, you have to declare who are you. So that's how the controls have been put in place to ensure AML and CFT. And regarding sales and promotion, so there is no scope of any advertisement for virtual digital assets in India. If you're trying to kind of promote or advertise, so the Advertising Standard Council of India, it prevents usage of words like cryptocurrency, securities, custodian, and depositories. Then going forward, so if you're a company who is trying to invest in virtual currencies and trade, right? So you have to disclose your profit and loss, the amount of currency held. All these things have to be declared before the Ministry of Corporate Affairs. So as far as the current status goes, there's a pending legislation, and in May 2024, the Securities and Exchange Board of India, which is a regulator for regulating securities, it proposed a multi-regulator framework for overseeing cryptocurrency activities. So this is kind of a body which will overall, in the long run, trying to regulate these activities among all regulators. And there is also already a consultancy paper on cryptocurrency which is issued in 2025, which will be subsequently issued, which will give a further clarity on the legislature's stance on crypto. So these are the regulatory authorities and roles as far as India is concerned. RBI, the Reserve Bank, remains cautious about decentralized cryptocurrencies. It emphasizes consumer protection, systemic risk. But at the same time, it leads CBDC development and regulates banking transactions with crypto entities. There's a Ministry of Finance which shapes the fiscal policy and tax regulations around crypto. SEBI, which I just mentioned, it is finally expected to regulate crypto assets classified as securities. And there is also a Digital Currency Board of India which was thought of, which is a kind of a proposed regulatory body under the 2021 bill to oversee the digital currency operations. So these are the current challenges and future directions. There's still a regulatory ambiguity, and there is, again, investors are not very clear about the stance of regulation as far as India is concerned. But there's always, India's approach today is to support blockchain technology applications beyond crypto. So there is a lot of use cases of blockchain beyond crypto, and there's a lot of support which has been given by Government of India. But cryptocurrency, crypto tokens, there's still a long way to go before this comes under a proper regulation. There's still infrastructure lacking for promoting cryptocurrencies, education, the digital literacy kind of things, the issues still there. India is kind of signatory, participating in various global forums. Yeah, so that is about stable coins. There is no legislation as of currently that directly takes stablecoin in its purview. So RBI has still maintained a cautious stance on stablecoins. So these are some of the cryptocurrency-related regulatory aspects as far as India is concerned. Now I shift focus to CBDC, Central Bank Digital Currency, which is also known as the digital rupee. The Reserve Bank of India launched the digital rupee in December 2022, which it was formed to create a blockchain-based sovereign digital currency to complement fiat money. It was designed to be traceable, secure, regulated, with the potential to enhance payment efficiency and financial inclusion. And it has actually both the retail and wholesale CBDC has been implemented in India, and cross-border CBDC projects are also on with some countries. So the idea behind launching CBDC was basically to boost the Indian economy by introducing a sovereign-backed digital payment system that mimics private electronic wallets. So these are some of the statistics around the usage of CBDC as far as in India is concerned. The number of retail users participating in the e-rupee pilot is expanding significantly by June 2024. So I have the data till last year. This year's data has not been published by Reserve Bank of India. The number of users had grown to around 5 million, have grown from 5 million to 1.3 million a year. And the number of merchants which are accepting e-rupee tokens, it has increased to around 4 lakh merchants. The transaction volume is concerned, the RBI is achieving its goal of 1 million daily transactions by December 2023. As far as the integration with other payment platforms, so there are a lot of fintechs who have come on board and working alongside with banks to popularize the CBDC payment app. So a company known as Cred is a fintech. It became the first fintech company to provide access to e-rupee with Yes Bank, one of the commercial banks in India. Also, we see the interoperability between CBDC and UPI. UPI, as you may know, is a real-time, is a faster payment or real-time payment system in India and has very good traction. This system has been in operation for the last 10 years. So now there has been attempt to integrate UPI and CBDC. So if I have a CBDC payment app, I can go to any merchant outlet, scan an UPI QR code and make payments. So that kind of initiative has already been taken by some of the banks. Going forward, there are other enhancements around CBDC which is happening. Offline functionality. So if there is no internet connectivity, and you can still scan a QR code and make payments through CBDCs. That kind of initiative has already been taken. Programmability. So as you may know that CBDC works on blockchain. So today we talk about programmable CBDC, where the token, the digital token, which is finally issued to the beneficiary, it can be, you can control the end use of that particular token. This particular phenomenon can be implemented using a smart contract. So this kind of initiative has already been taken. In April 2024, IndusInd Bank, one of the commercial banks in India, has actually facilitated programmable e-rupee transactions to compensate farmers for carbon credits. Then there are certain institutional cross-border use cases. The Reserve Bank of India has initiated trials by depositing reimbursement allowances into its officers' digital currency wallets, which is demonstrating the government's commitment to adopting e-rupee for official transactions. And as I mentioned some time back, there are cross-border collaborations. There's a collaboration that is currently with the UAE Central Bank. So RBI is engaged with the UAE Central Bank to explore the viability of using e-rupee for cross-border settlements, aiming to enhance the efficiency of international payments. As far as other market developments and partnerships are concerned, Reliance Retail, one of the big retail chains in India, it has partnered with a company called as Innovative Technology, ICICI Bank and Kotak Bank, to become the first major retail chain in India to accept e-rupee payments at its Fresh BIC stores in Mumbai. And we also see some of the fintech companies like Mintalk, which has kind of acquired DigiLedge, which is kind of offering CBDC payment services. So there has also been collaboration between payment companies in this direction. Yeah, so that's what I wanted to say about the initiatives around crypto regulation in India and the CBDC current status. Yeah, that's about me. Thank you.
Many thanks. And now, last but not least, Dr. Jürgen Schaaf.
Thank you very much. Thank you in particular, Professor Barresi and Professor Sati, for the invitation to speak here. Perfect organization, very much hospitality, great event. I feel very honored to be among these distinguished experts and academics, and I think I'm the last speaker. Yes. And I was wondering, after we've been speaking so much about cutting-edge technologies, new projects, pilots and projects that are far from being operational in the crypto and technology-based dematerialization of money, we haven't spoken at length about the mother of all this in a bit more detail, namely Bitcoin. And it is my very pleasure to share with you the summary of a paper I was drafting and writing with Ulrich Binzer, who is the Director General of Market Infrastructures and Payments at the ECB. And we were looking into a scenario where Bitcoin rises forever and the distributional consequences of that. and I will guide you through this now. You will find the whole paper, if you are a gourmet and want to know the technical and model details, at SSRN. So, where do we come from? Many of you will remember, but still I want to recall where all this started with Bitcoin, the mother of crypto, if you will. The original idea, in a reaction also to the financial crisis, so mistrust in the financial system, banks, the government, and all that, but also a hype in crypto technology, led into the white paper of Nakamoto in 2008, where Bitcoin was presented, promising a peer-to-peer payment system being completely decentralized, detached from the government, detached from the financial system, without a trustworthy intermediary, and the like. That was the promise. Reality is that today, Bitcoin is hardly ever used for legal e-commerce. The important change took place in the middle and late 2010s, when the notion of that this is the new payment system was transformed into the idea of an investment vehicle. It was an attractive vehicle. So it was effectively becoming more an investment rather than a currency. And all the supporters, the early ones, but even more so the latecomers, are hoping that the price will continue to rise and there's not even a justification. So if we look at the traditional traits or feature of an investment, then we can see that Bitcoin doesn't have any of these. So if you have a normal investment, it generates a cash flow, interest payments, dividends or rents. So interest for bonds, dividends for shares, or rents for real estate. If you invest into raw materials or commodities, they have a usage in industrial production. There is a demand based on business needs that will finally end up in products. None of this applies to Bitcoin. So it's purely driven by the belief in ever-rising value. This belief, in particular in the retail areas, has been fueled by celebrities, financial elites, and a bit more current politicians. They fueled the narrative. There's a value that will rise forever. So there's a creation of an illusion of a guaranteed wealth and wealth increase. The question we were asking ourselves is who gains and who wins? So if we have a look at this in an economic context, we have a look at technologies and their impact on the productive potential of an economy. If you have a look at true technological innovations like Apple, Nvidia, Amazon, and the like, they raise the productivity by their new technologies, raising the productivity of the economy, thereby potentially increasing income and wealth. Bitcoin does neither of this, and it also doesn't produce a new good, which is the other classical innovation in the Schumpeterian context, as we heard also earlier today. So if you have now wealth increases, be it just in calculated and not materializing, but in your personal balance sheet or in the balance sheet of the economy, if you have wealth effects, this risks inflation if it's not offset by productivity increases. So there's a risk of inflation, and for our model, I will get you to that in a minute, but in case inflation is generated, then the central bank would need to interfere and tighten monetary policy. in our model, deviating from the standard economic assessment of Bitcoin, which assumes it's a speculative bubble that will burst eventually, and there are valid reasons for that, but we took a more narrow perspective, said, okay, what if it's not bursting? So our assumption is there will be no crash, that the price of Bitcoin rises steadily. We separated, we distinguished two camps. One is the early birds, the early adopters, and depending on how much fiat they invested, they are normally equal to the so-called whales, and the latecomers, which are now, or last couple of years, the retail investors. We assume that the central bank responds appropriately to avoid inflation, so we exclude inflation. We have the two groups, early birds and latecomers, and actually we could also integrate those who will never buy at all. In order to get Bitcoins for the latecomers, the early birds, so the early investors, have to sell to those who come later. The latecomers have to fund this in our model by selling real assets, so they can sell their equity, they can sell their stocks and bonds, or by reducing their consumption. So they need to get somehow the funds in order to buy from the existing stock. The result is that the early birds, the early investor of Bitcoins, those who hold, get richer, and they can consume more, while the latecomers lose wealth and purchasing power alike. So I will not guide you through this lovely table. It's just to show you that there are some real calculations and models underlying. Now, the results of our simulations were that even with convergence, so if the gap, if you have an equalization of the holdings of Bitcoin over time, in a long time horizon, the early birds retain more wealth and real assets, so also independent from Bitcoin, and the consumption gaps between the early investors and the late investors will persist. So by investing now in a late stage or in a later stage of the development, you will not be able to catch up the wealth effect of the early investors, even if there will be no crash. That means the redistribution, and that's what is the underlying economic process, continues, even if holdings are equalizing. It's about wealth transfer, and there's no wealth creation. So, if you see all the bragging influencers and the whales and the like on the various YouTube channels and the like, questions, if you ask who really pays for the Lamborghinis, the Rolex and the like that they own and show you, it's the non-holders and the latecomers. So their consumption drops to fund the wealth of the early ones. So what this means is that the threats coming from this innovation, if you will, it's not just about price crashes, so the bubble burst, and it's not about the timing when to invest. Even in a perfect perpetual bull market, the latecomers will always lose. And the real economy and the society will not benefit. So, going a step further, away from the economic perspective, we see that there is one of the consequences rising inequality, additional erosion of trust in financial fairness. You remember the entire creation of Bitcoin was a reaction to the shock in the financial system around the great financial crisis and the distrust in banks and the financial system. But this could add a new layer in the erosion of trust in financial fairness, and of course, discontent among the non-holders. And in the various crashes we've seen, we saw massive losses of retail investors, age saving, pension savings, and the like were completely eroded, and discontent could even destabilize social cohesion. So what are the policy implications for this? It's not necessarily about banning, but the regulators must at least consider these hidden costs, which go beyond a potential crash of a more or less unleveraged risky asset. We would suggest clearer communication and also a clearer stance on the risks and the true effects of Bitcoin. And the focus should be on the redistribution impacts that there may be. And, oops, sorry. With that, I think I maybe gained you already a minute or so, but thank you for your attention.
Thank you very much for your perspective to share with us. And I want to thank you all the speakers for giving us their perspective. And I thank you for waiting for the finish of this section, and see you tonight for the Gala event. Thank you very much.
Yes, for whom have bought the ticket, we have the conference Gala evening. I take the opportunity to greet and to welcome to Florence Geraldine Escolar, who should be, sorry. Tomorrow we will have the pleasure to have Geraldine as the chair of the final roundtable and the closing keynote. But exactly tomorrow, if please, they can show in the website that no one saw, but doesn't matter, that there was a problem of extraordinary maintenance of the water in Florence. They told us on April 29, so the government informed us, and this campus where was previously expected the final roundtable is closed tomorrow. So to avoid misunderstanding, you have in the venues of BIC25.org, but can explain if you come to the conference Gala evening where is it is, you have all the information about Villa Ruspoli, and nothing happened by the case, because Villa Ruspoli is the headquarters of the Department of Law, is the house of an important constitutional judge who was professor here at the University of Florence, is dead in 2022, Professor Paolo Grossi. So I think another prestigious venue in order to conclude our proceedings. Thank you so much. I've seen you in a while at the Theater of Maggio Musicale Fiorentino. Thank you.